Are you ready to unlock the secrets of international accounting and elevate your financial expertise to new heights? Whether you're a seasoned professional or just dipping your toes into the world of finance, this video is your passport to success in today's global marketplace. From deciphering the differences between GAAP and IFRS to unraveling the mysteries of financial statements, auditing, and compliance, we've got you covered. Get ready to embark on a journey of discovery as we demystify complex concepts and empower you with the knowledge and skills you need to thrive in the dynamic world of international accounting. So grab your calculator and buckle up, because this is one ride you won't want to miss. Essential International Accounting Terms, your roadmap to success. Greetings, colleagues. Are you ready to take your financial fluency to the next level and pave your path to success in the global marketplace? Today, we're embarking on an exciting journey through the essential international accounting terms that will serve as your ultimate roadmap to triumph in the world of finance. Welcome back to the 4 Business English Rundown, where we transform complex concepts into captivating content. In today's video, we're diving deep into the realm of international accounting, where understanding the language of finance is paramount. Whether you're a budding entrepreneur, a seasoned professional, or just someone looking to expand your financial vocabulary, you're in the right place. So let's be about it. Introduction to International Accounting. Welcome to our deep dive into the captivating world of international accounting. In today's globalized economy, where businesses operate across borders, understanding international accounting standards is absolutely crucial. So why are those standards so important, you might ask? Well, let me break it down for you. Imagine you're a company based in New York, but you have subsidiaries in London, Tokyo, and Sydney. Each country may have its own set of accounting rules and regulations, making it challenging to compare the financial performance of your different branches. This is where international accounting standards come into play. They provide a common language for financial reporting, ensuring that businesses around the world follow consistent guidelines when preparing their financial statements. But it's not just about making things easier for multinational corporations. International accounting standards also promote transparency, comparability, and consistency in financial reporting. Transparency means that investors and stakeholders have access to accurate and reliable financial information, allowing them to make informed decisions about where to invest their money. Comparability ensures that financial statements from different companies can easily be compared, providing valuable insights into industry trends and benchmarks. And consistency means that financial statements are prepared using the same methods and principles year after year, enhancing the reliability and trustworthiness of the information presented. So whether you're a small startup or a global conglomerate, understanding international accounting standards is essential for navigating the complexities of today's interconnected business world. Stay tuned as we explore more key concepts and vocabulary in international accounting. Key international accounting terms. Let's dive into some of the most essential international accounting terms that you need to know to navigate the world of finance with confidence. First, we have GAAP versus IFRS. GAAP, or GAAP, stands for Generally Accepted Accounting Principles, which are accounting standards used primarily in the United States. On the other hand, IFRS stands for International Financial Reporting Standards, which are used in many countries around the world. The main difference between the two lies in their principles and guidelines for financial reporting. While both aim to provide accurate and reliable financial information, they may have slight variations in their rules and requirements. Understanding the differences between GAAP and IFRS is crucial for businesses operating internationally, as they may need to comply with both sets of standards depending on their geographic locations. Next, let's talk about consolidated financial statements. Imagine you're the CEO of a multinational corporation with subsidiaries in various countries. Each subsidiary prepares its own financial statements, but as the parent company, you need a comprehensive view of the entire group's financial performance. This is where consolidated financial statements come in. They combine the financial information from all subsidiaries and present it as if the entire group were a single entity. Consolidated financial statements provide stakeholders with a holistic view of the group's financial position, enabling better decision-making and analysis. Lastly, we have fair value accounting. This valuation method is based on the current market price of assets and liabilities, rather than historical costs. In other words, fair value accounting reflects the current economic conditions and market trends, allowing for more accurate and relevant financial reporting. Fair value accounting is commonly used for assets such as stocks, bonds, and real estate, as well as liabilities like derivatives and contingent liabilities. While fair value accounting provides a more dynamic and transparent view of an organization's financial position, it can also be more subjective and susceptible to market fluctuations. So there you have it. These key international accounting terms are essential for understanding the intricacies of financial reporting in today's globalized economy. Stay tuned as we explore more fascinating concepts in vocabulary and international accounting. 5 quick terms that you need to know in international accounting. The first is FIFO, or FIFO. This is first in, first out. And related to that, of course, is LIFO, last in, first out. And some example sentences that might clear up what this means. The company uses FIFO to determine the value of inventory, where the oldest inventory items are sold first. LIFO is an inventory valuation method that assumes the last goods purchased are the first goods sold. And when would this come up? You could imagine a company that buys goods repeatedly, more than once. As it makes multiple purchases, it's going to pay different prices. And as it's buying, it might also be selling. Imagine it's a distributor. It's buying products from the factory and it's selling those goods to the retailers. And it might be buying and selling at the same time. But as it's buying and as it's selling, the prices are going to change as the market conditions change. So from an accounting standpoint, it may be important to know, which inventory is sold, not necessarily physically, but just from an accounting standpoint. Is it the first ones that were sold, the first things that you bought, or is it the last ones that you bought? And that's where FIFO or LIFO come in. ROA, return on assets. ROA measures a company's profitability by comparing net income to its total assets. ROE, return on equity. ROE measures a company's profitability by comparing net income to its shareholders' equity. EPS, earnings per share. The company's EPS increased by 10% compared to the previous quarter. Hopefully you've understood these 5 terms. Let me know if there are other terms that you want to know. Actually, when I was researching and coming up for the list of terms to talk about in today's episode, I came up with many more than I could use in a single episode. So let me know in the comments below if you want to hear more about accounting terms. And I might even make a short course on the website about these terms because there are so many, and I know there are a lot of people interested in these accounting terms. So let me know what you think in the comments below. Financial reporting and analysis. Welcome to the heart of financial reporting and analysis, where we'll delve into 3 fundamental documents: the income statement, the balance sheet, and the cash flow statement. Let's start with the income statement. This financial document provides a snapshot of a company's profitability over a specific period of time, typically a quarter or a year. It breaks down the company's revenues, expenses, and resulting net income or loss. Revenues represent the money earned from selling goods or services, while expenses include the costs incurred in generating those revenues, such as operating expenses, taxes, and interest payments. By analyzing the income statement, stakeholders can access the company's ability to generate profits and manage its expenses effectively. Next up, we have the balance sheet. Think of the balance sheet as a financial snapshot of a company's financial position at a specific point in time, usually the end of a reporting period. It consists of 3 main sections: assets, liabilities, and equity. Assets are resources owned by the company, such as cash, inventory, and property. Liabilities are obligations owed by the company, such as loans, account payable, and accrued expenses. Equity represents the ownership interest in the company, including retained earnings and shareholder equity. The balance sheet provides valuable insights into the company's liquidity, solvency, and overall financial health. Last but not least, we have the cash flow statement. This document tracks the inflow and outflow of cash and cash equivalents over a specific period of time. It's divided into three main sections: operating activities, investing activities, and financing activities. Operating activities involve cash transactions related to the company's core business operations, such as sales and expenses. Investing activities include cash transactions related to investments in assets, such as property, plant, and equipment. Financing activities involve cash transactions related to borrowing, issuing stock, and paying dividends. The cash flow statement helps stakeholders evaluate the company's ability to generate cash, manage its liquidity, and meet its financial obligations. So there you have it. Understanding these key financial reporting documents is essential for analyzing a company's performance and making informed investment decisions. Stay tuned as we explore more fascinating concepts and vocabulary in international accounting. Auditing and compliance. Now let's shine a spotlight on auditing and compliance, two critical components of the international accounting landscape. First up, we have internal control. Think of internal control as the guardrails that organizations put in place to ensure accurate financial reporting and prevent fraud. These systems and processes encompass a wide range of activities, including segregation of duties, authorization and approval procedures, physical safeguards, and monitoring mechanisms. By implementing robust internal controls, companies can safeguard their assets, maintain the integrity of the financial data, and comply with regulatory requirements. Internal control is like the engine that keeps the financial machinery running smoothly, ensuring transparency and accountability at every step of the way. Now let's talk about external audit. External auditors play a crucial role in verifying the accuracy of financial statements and ensuring compliance with accounting standards. These independent professionals review the company's financial records, policies, and procedures to provide an objective opinion on the fairness and reliability of the financial statements. External audits help stakeholders such as investors, lenders, and regulators gain confidence in the company's financial reporting and decision-making processes. By conducting thorough examinations and assessments, external auditors help uphold the integrity of the financial reporting system and promote transparency and trust in the marketplace. So whether it's implementing robust internal controls or undergoing rigorous external audits, auditing and compliance are essential aspects of the international accounting landscape. By understanding these key concepts, you'll be better equipped to navigate the complexities of financial reporting and ensure the integrity and reliability of your organization's financial information. With these essential international accounting terms under your belt, you're well equipped to navigate the complex world of finance with confidence and clarity. Remember, continuous learning is the key to success, so keep exploring and expanding your financial knowledge. For now, watch this next video from the 4 Business English Rundown. Remember to conquer that like button and make it ours. Hope to see you in the next video.